Welcome to our lecture on international financial management, focusing on international flow of funds. Today, we will talk about balance of payments, its determinants, and how it affects foreign exchange rates as well as economies. Let's begin. International financial management explores the movement of money across countries, a critical aspect of global economic interaction. These flows are meticulously tracked through the balance of payments, which records all international economic transactions of a country. Understanding these movements is essential for analyzing exchange rates, financial crises, trade imbalances, and global macroeconomic policy. The balance of payments summarizes a country's economic transactions with the rest of the world, comprising two major components: the current account and the capital and financial account. The current account tracks flows of goods, services, income, and transfers, reflecting a country's net income. For example, exporting U.S. soybeans to China is a credit, while importing German cars is a debit. The capital and financial account tracks investment flows, such as foreign direct investment, portfolio investment, and changes in foreign reserves. This account records the net change in ownership of foreign assets and liabilities. Various factors affect international trade. International trade is influenced by several macroeconomic factors, including exchange rates, interest rates, inflation, GDP per capita, and government policies. A strong U.S. dollar makes U.S. imports cheaper but exports more expensive, impacting trade balances. Higher U.S. interest rates attract foreign investment into dollar assets, strengthening the dollar. Countries with lower inflation become more competitive internationally as their goods and services are relatively cheaper. Growing economies with higher GDP per capita tend to import more goods and services. Government influence through subsidies, export credits, tariffs, and bans significantly affects trade flows. Governments shape trade flows through currency policies, outsourcing policies, protective trade policies, and environmental and labor policies. Currency policies such as foreign exchange intervention can weaken or strengthen the domestic currency to influence trade outcomes. Lowering interest rates or selling domestic currency can weaken it, making exports cheaper and imports more expensive. While this can be helpful short term, it risks causing inflation and potential currency wars if multiple countries devalue simultaneously. Foreign investment includes portfolio investment and foreign direct investment. Portfolio investment involves buying foreign stocks, bonds, or financial assets with returns affected by foreign exchange movements, interest rates, and inflation. Foreign direct investment involves long-term control in foreign firms or assets, offering access to new markets and lower production costs. Foreign direct investment brings benefits like job creation, technology transfer, and infrastructure investment, but also carries risks such as political instability and exchange rate volatility. Major international financial institutions like the International Monetary Fund, World Bank, and World Trade Organization play crucial roles in global money flows. The International Monetary Fund promotes global financial stability by providing short-term loans during balance of payments crises. The World Bank provides long-term loans and development assistance to emerging and low-income countries, focusing on poverty reduction and infrastructure. The World Trade Organization regulates global trade rules, settles disputes, and ensures fair and predictable international trade practices. Other organizations like the OECD, OPEC, and EXIM Banks also play specific roles in economic statistics, oil production, and export financing. International unions and regional agreements, such as the EU, Eurozone, USMCA, ASEAN, Mercosur, and AFCFTA, promote trade and investment. The European Union is a highly integrated economic and political union promoting free movement of goods, services, capital, and labor. The Eurozone, consisting of European Union countries using the euro, eliminates exchange rate risk and lowers transaction costs, though countries give up independent monetary policy. The USMCA, formerly NAFTA, modernizes trade rules for North America, strengthening supply chains and encouraging cross-border investment. Other examples like ASEAN, Mercosur, and AFCFTA aim to reduce barriers and support multinational corporations entering emerging markets. U.S. international trade data includes exports and imports by country, trade balances, unit value indexes, and trade by product category. The U.S. consistently runs its largest bilateral deficit with China, driven by high imports of electronics, machinery, and consumer goods. This imbalance influences exchange rate policy debates, tariff discussions, and national security concerns related to supply chain dependence. The U.S. is a global leader in high-value exports such as Boeing aircraft, LNG, and semiconductors, strengthening its trade position. Conversely, the U.S. imports many consumer and industrial goods from abroad due to lower labor costs or specialized manufacturing ecosystems. These trade patterns shape global supply chains and inform industrial strategy and trade negotiations. Understanding the international flow of funds is crucial for students to grasp the complexities of global economics and financial management. Thank you for watching our lecture video on international flow of funds. See you at the next lecture.